understand if they reflect ongoing business costs or genuine one-offs and how they impact future cash flow.
Requires judgment based on the specifics. What about valuing businesses with very little capital? Service businesses, maybe.
Right, capital-light businesses. Exhibit 24.9 uses a hypothetical trade co. These companies can have incredibly high, almost meaningless-looking ROICs because the invested capital denominator is tiny.
So ROIC isn't as informative there.
It needs careful interpretation. Often, the value is driven by working capital efficiency, managing receivables and payables, rather than traditional return on assets. Economic profit might be a more meaningful measure in these cases.
The book also mentions an alternative return measure, CFROI.
Yes, cash flow return on investment. It's calculated differently from ROIC and can be useful, as shown in Exhibit 25.2, particularly when cash flows are closely tied to the gross pre-depreciation value of invested capital. The main point is there's no single perfect measure. You choose the one that best reflects the economics of the business.
We touched on inflation consistency. How does it play out in the forecast details?
You need to be consistent everywhere. If you assume 2% inflation in your revenue growth, you generally need to reflect that in your cost growth, your working capital assumptions. Inventory, receivables, payables will likely inflate, and potentially in capital expenditures. Exhibit 26.3 shows how financial projections differ with and without passing through inflation. Crucially, your discount rate, WACC, must also be consistent. Either use nominal cash flows with a nominal WACC or real cash flows with a real WACC.
Mixing them up would be a major error.
Huge error. For cross-border valuations, things get even more complex, right? Currencies, different economic environments.
Definitely adds layers. You have to forecast cash flows in foreign currencies, then decide how to translate them back and figure out the appropriate discount rate should it reflect risks in the foreign country or the parent's home country. Lots of debate there.
There is. The book touches on global CPM models and concepts like purchasing power parity. For subsidiaries in countries with moderate inflation, the standard current method is often used for translating financial statements.
Okay, let's shift to managing value. Corporate portfolio strategy. The best owner concept.
This is key for deciding which businesses a company should be in. The idea is simple. A business should be owned by the entity that can create the most value from it.
The best owner.
Right. If another company could run one of your divisions better and create more value, perhaps you should sell it to them. If you see a business out there that you could improve significantly, maybe you should acquire it. It's about finding the best fit between the business and the owner's capabilities. And that best owner can change over time.
A dynamic view. Managers have biases, though, right? Like risk aversion.
Yes, the book highlights this. Managers often exhibit loss aversion, weighing potential losses more heavily than equivalent gains, which can make them shy away from valuable but risky investments.
How can companies counteract that?
By taking a portfolio view at the corporate level. Diversifying across many projects means the failure of one is less impactful. Centralized resource allocation, ranking projects across the whole company based on value creation potential, can help overcome individual managerial biases.
Use the corporate structure to diversify. How can companies use these value drivers for ongoing performance management?
By breaking down the high-level metrics. Exhibit 29.10 shows a value driver tree. You disaggregate ROIC into things like margin drivers, price, cost efficiency, and capital efficiency drivers, inventory turns, asset utilization. This helps managers see exactly which operational levers they need to pull to improve overall value.
Makes it actionable.
Exactly. Connects strategy to day-to-day operations.
And fostering a value-focused culture, what does that involve?
Strong governance committed to the long term, clear strategic initiatives with accountability, and performance reviews focused on those underlying business drivers, not just hitting quarterly accounting numbers.
Moving beyond short-termism. M&A is a big part of strategy for many. How can acquisitions create value? It seems hard.
It is hard. Acquisitions can accelerate strategy, fill capability gaps, or consolidate industries. But ensuring they actually create value for the acquirer's shareholders is tough.
What does the research show?
A McKinsey study suggests M&A on average does create some value for the combined entity, but the distribution is wide. Success rates seem higher for large deals in slower-growing sectors and for companies that are programmatic acquirers doing regular, smaller deals aligned with strategy.
What are the key pitfalls?
Overpaying is the classic one, especially in hot markets. Failing to properly plan for and achieve the expected synergies, the operational improvements, is another. The payment method, cash versus stock, matters too, as it affects risk sharing. Having a clear strategic rationale and managing the integration process well are critical.
What about the flip side divestitures?
Yeah.
Selling off businesses. Can that create value?
Yes, evidence suggests divestitures can create value, Exhibit 32.2. Often, it allows both the parent company and the divested unit to focus better. But again, success isn't guaranteed.
Depends on execution.
Definitely. Careful preparation, speed, and managing the complexities like lost synergies between the businesses, the costs of separating them, and potential stranded overhead costs are all important. There are also different ways to divest. Private sale, spin-off, equity carve-out, each has pros and cons.
Okay. Capital structure, debt versus equity and payouts like dividends and buybacks. What are the key takeaways?
The main trade-off with debt is the tax shield benefit versus the costs of potential financial distress if the company struggles. However, the book suggests capital structure often has less impact on overall value than people sometimes assume within a reasonable range.
Most large companies aim for investment grade ratings.
Yes. Exhibit 33.7 shows most cluster in the A to BBB range. Regarding payouts, share repurchases have become very popular. Investors often see them positively, maybe as a sign management thinks the stock is cheap, or as a flexible way to return cash without committing to a permanent dividend increase.
More flexible than dividends.
Generally, yes.
Lastly, investor communications. How should companies manage that?
Focus on the long term. That's the core message. Build relationships with intrinsic investors, those focused on long-term fundamental value. Don't get overly distracted by short-term traders or quarterly earnings noise.
What about earnings guidance?
The book questions its benefits, citing analysis showing companies that stopped providing guidance didn't necessarily suffer negative TSR consequences. The emphasis should be on communicating the long-term strategy and value drivers, not obsessing over hitting precise quarterly analyst forecasts.
The focus on the substance. The book also briefly covers special situations, emerging markets, high-growth firms.
Yes, it acknowledges the extra challenges. Emerging markets have heightened political and economic risks. High-growth companies face immense uncertainty. But the core valuation principles still apply. DCF combined with rigorous fundamental analysis and scenario planning remains the recommended approach, especially for high growth.
What about cyclical companies and banks?
Cyclical companies obviously require careful thought about where you are in the business cycle when forecasting. Banks are particularly complex due to leverage, regulation, and the nature of their business. Valuation by parts, for example, lending, fees, trading, and using specific metrics like economic spread analysis, Exhibit 38.8, are often helpful.
And the idea of real options valuing flexibility.
Right. This recognizes that investment decisions often aren't just yes, no, now, but involve flexibility, the option to delay, expand, contract, or abandon a project later based on how things unfold. This flexibility has value, especially under uncertainty. Exhibit 39.2 shows how a project might look bad on a static NPV basis, but valuable when you consider the option to proceed only if early results are good.
Quantifying the value of waiting or adapting.
Exactly. Real option valuation, ROV, tries to capture that, driven by factors like uncertainty, time, and the cost of exercising the option.
The appendices sound like they tie a lot of this together technically.
They do. Appendix A clearly shows the mathematical links between DCF, economic profit, and invested capital. Appendix C dives deep into WACC components like levering beta and the value of tax shields. Appendix G touches on global CAPM issues, and Appendix H is that full, detailed Costco valuation example, putting it all into practice.
So wrapping this all up, it really comes back to that core idea, doesn't it? Value creation is about earning returns on your investments that exceed the cost of those investments. Profitable growth.
That's the fundamental engine, ROIC greater than WACC, and valuation is the toolkit to understand and measure that, looking at the financials, the industry, the strategy, the risks. It's holistic.
Hopefully listening today has sparked some of those aha moments for you.
Yeah.
Maybe it was the point about cost of capital consistency across different company types.
Or debunking the conglomerate discount myth, perhaps, or just realizing how challenging sustained high growth actually is for most companies. Little insights that change perspective.
We definitely encourage you to dig deeper into anything that caught your attention. Maybe it's the mechanics of DCF, or understanding WACC better, or the specifics of valuing banks or high-growth tech.
Absolutely. And maybe a final thought to leave you with. In today's constantly shifting business world, what does it truly take for companies to not just create value, but to sustain it? How crucial is continuous learning and adapting our own understanding of value in this landscape?